Okay.
Thanks for the reminder.
Yeah, I didn't do it.
I didn't.
All right. So yeah, a little about me. If you don't know me, I've been at it since like 2002. Been a broker, been on the like retail bank side for a little bit. I've owned Price Mortgage a little over almost, so it'll be 6 years in March. So we have over 100 employees, and we did over $1 billion last year in funding. So we've seen lots of loans, and I'm ranked up there pretty high as far as numbers go. So I try to take all the things I see and help my agents, with scenarios and things they come across to find the quickest solution to get deals done. But yeah, we're going to go over a few things today. We're going to, just kind of look at rates, the year-over-year trends, loan limits, some pricing strategies, seller concession limits, and just a few things about the 2-1 buy down and kind of how that works as well. That's kind of like, to me, seems like one of the only ways to create affordability in the market so buyers can buy and sellers can sell. So let's see here. So yeah, so basically these are pretty close. We might see some that are a little lower, a little higher depending on credit score and things like that. But we're the rates we're seeing today are things we haven't seen since like 2007, 2008 for these loans. And at that time, home values were probably a third of what they are today, especially after the crash, they were even lower. And then rates dropped, and then they've been pretty low ever since. We've had a few ups and downs, but nothing back in these ranges. I was listening to Barry Habib. He runs more MBS Highway. MBS stands for Mortgage Backed Securities, and he kind of tracks the rates, inflation, all that stuff. Kind of gives us forecasts on what he expects rates to do. Um, we need to probably mute somebody here. I'm not sure that is. Make sure to mute your mic if you're not talking. But anyway, he was saying that they look at inflation like 1 year look back. So inflation started to tick up last year around October, November, December, and so on, and took off after that. So as they start doing that, the inflation spread will be a lot better. And so he's expecting, which I've been thinking all along. I figured first quarter, second quarter next year, we should see rates again. I really think in these price points, rates really need to be in the high fours, mid fives for most people to, have it be a workable payment for them. And that's, we're way over that right now, and that's what's hurting people. And we'll talk more about that with the buy down. But anyway, we'll go ahead and proceed. So this is just based on these numbers here are my company, what like our average rate in these different years for 2020, 2021, and 2022. These are average loan sizes, average, interest rates. You can see it's still trailing pretty bad for 2020. I mean, we still have an average rate of 4.76. Most of the first year or half or like the first quarter this year, rates were still threes. They started getting in the fours, still really good. People could buy. We didn't see any really issues in the market, right? And so that's kind of been happening since they've gotten up in the five, sixes, sevens, depending on who you're working with, even eights. I've seen some people tell me they've been quoted. But this is kind of a more breakdown, like a bit of breakdown of this year. So you can see like quarter one, 3.59. You can see that average loan size. Quarter two, 4.84 average rate. And then quarter three, we're at 5.86. And, quarter four is probably going to be somewhere in the sixes. And it's kind of like you can see here too. It's kind of interesting. You can see that average loan size tick down a little bit too, not by much, but it did in quarter three. And we'll probably see quarter four. That could be a similar situation. But yeah, this is just spread out over, like, I think we had $1 billion funded last year, probably 3,000 something loans. So last year's numbers are a pretty big pool of loan sizes and loan types and everything. So one thing when you guys are listing houses, it's extremely important to know what the loan limits are for different financing types. And it's when you don't know, it can really make or break maybe how many people you're getting, looking at the home. You got to figure, most people don't want to put 20% down. Most people are trying to do less down. So how do we price our home if it's close to one of these loan amounts to help it sell? One nice thing about, any loan type, well, mainly conventional FHA, is you can see as the unit amount goes up, like you have a 1 unit, a duplex, threeplex, fourplex, you can see those loan amounts go up. Right now, some lenders are still doing 647, 200. That's the true loan limit this year for conventional. But most lenders are letting us go up higher to 715 for a 1 unit. And so that, just allows more people to kind of get into something a little bit more higher price and do less down. So here's an example. We have a $715,000 loan amount. Most people, if they're buying that, it's probably not their first home. So it's probably like they probably owned a home in the last 3 years. So 5% down is going to get your most borrowers on that, because most loans are still conventional over any other loan type. Almost, the lion's share of loans are conventional. So if I was going to list this house at 760 or 780, like I have a listing in that range, whatever, let's say 760, at 750, basically if I divide that 715, if I take 715 and I divide it by 0.95, so I work backwards, that's what would it be if I was putting 5% down? That would be a list price or a price that would let me do 5% down at 752, 631. So, if I come in and I list, like if I was going to come in at 760, I'd capture a lot more borrowers if I just came in at 752, because that's 5% down. So those are instances where you might be really close, but it might miss. And unfortunately, not every loan officer is going to tell their client, well, hey, you can just put a few more bucks down, or hey, see if you can get a little lower. They might just say, oh no, I'm sorry, that's too high. And that's the end of the conversation. And that borrower moves on to another house. So you don't want to rely on loan officers to maybe come up with creative solutions always, because not all of them do. And so, I'm sure if they were talking to me, I'd tell them, hey, just you need to put a few more bucks down, you're good to go. Or hey, see if you can get the price down. So these are things that kind of keep in mind. FHA, same thing. I mean, FHA requires 3.5% down. If I divide that by 0.965, that gives me a price of 457, 600. So if I'm at 500, if I'm at 505, I'm sorry, if I'm at like 470, 465, and my house isn't moving, you can capture more borrowers by coming down to that 457, 458, and they can get an FHA loan. And then some do 5% down and 10% down, but that just gives you kind of an idea. So knowing these numbers, like even the FHA, look at these loan limits when you go to a 2-unit, 3-unit, 4-unit. Like, yeah, FHA is available on these. If they're going to live in one of the units, these are the max loan amounts. So they can put 3.5% down on a 4-unit property. So basically 880 list price. So definitely keep these numbers handy when you're listing homes. If you have something near these ranges, it might be worth reducing it a little bit to fit into one of these boxes, or get it closer to like where you have access to more borrowers, and you're not just priced a little too high to get more borrowers. USDA, USDA certain areas, there's very few left now. There's a link here. I'll click on it real quick because I want to show you guys this. And you can always check with your loan officer too. Like I check these for people all the time, but when you go to this site, do you guys see this on here, Jessica?
Yes. Yes.
You see the USDA site?
Yep. Yes.
Okay. So if I go, it's called Housing Direct, is when the USDA does the loan directly. Very few people qualify for that. You're not going to worry about that. You're just going to look at guaranteed. That's where you work with a lender like me and get a USDA loan. So single family housing guaranteed. So you can, it has income limits, things like that. I think it's like 100,000 now for a 1 to 4 person or 2-person household. It's pretty high. So very few people are having issues with the income limits. But anyway, property eligibility lets you know if the home is USDA approved. So we can accept. I'm not gonna. You can put an address in right here, and it'll tell you yes or no. And it's kind of a dumb map. It's hard to really share it. But if you go on there, you can see this darker color, this more of a yellow color, I guess. Sometimes I don't see colors well, but that's ineligible areas. Like Buckeye a long time ago was in it. A lot of areas there, like Santan Valley, Queen Creek, stuff like that. Nowadays, even Gold Canyon, Apache Junction, they were in it. Like all that stuff's gone. What we're mainly seeing it is in Florence, Coolidge. There's a ton of USDA opportunities here. in these two areas. You can see that's that lighter color. If you go out west, I mean, you can see it's pretty much none of Buckeye. You're already basically 339th Avenue, so like Tonopah, those areas you're in. So if you're ever out in any of these areas listing a house, make sure you check the address, or I can check it. But if you want to do it yourself, you can go in here and check it. If you have a USDA borrower, definitely always, use this as a resource. USDA is a great loan. It's a zero down loan, no down payment like a VA loan. It's really the next best loan compared to a VA loan. The funding fee is only 1%. FHA is 1.75 for their upfront mortgage insurance. And then the monthly PMI is 0.35, which is basically almost half from what FHA is. So it's a much more affordable loan for people. Like, it's a lot better payment than a USDA loan. Like, usually the payments end up lower even with zero down than an FHA loan. It's just finding a property that's eligible.
Andy, I have a question.
Yeah.
For the USDA loans, does the property have to be affixed a certain way in order to qualify for that loan?
So it can't be a multi-unit. It has to be, if it's resale, it's pretty much single family resident, condo, townhome. You can't do manufactured home resale.
Oh, you can't.
No, the only time you can do a manufactured home, there's two exceptions. One is they're buying it directly from the builder, like somebody installed it and they're the builder and they're selling it and no one's lived in it. So that's eligible. And then if the current seller has a USDA loan,
I see.
that can make it eligible. Those are the only two ways you'll be able to do a manufactured home.
Okay, I see.
Now FHA, different story, right? One thing about, and this is just a side note, when you're dealing with a manufactured home on a listing side or buyer side, there's a few extra steps. Like conventional VA, you don't usually need an engineer cert, foundation cert. People call them both things. That's where they make sure that the foundation is affixed a certain way. They have tie downs, things like that. The VA, FHA, and conventional really don't care about that. FHA always wants one. Where you're going to run into needing one on other loan types like the VA and the conventional is if there's things attached to the home, like a patio shade or a little, extra shed or something attached, a deck, things that get attached to the home.
Okay.
After it's installed, then they'll want one a lot of times.
Okay.
If there's not rails down the stairs, you'll get called out on that. So things of that nature. A lot of them are on septic, so you have to get a septic cert. Most foundation certs are about $400 to $500. I have a pretty good guy that if you ever need one, his name's Robert at Simple Solutions. He does a good job. He goes all over the valley, all over the state.
Okay.
Yeah, he can do them. And then sometimes when they don't meet it, like they don't have the right tie downs, then you have to get the tie downs installed, and then they have to go back out and make sure it's done. And that usually costs about $700 to $1,000 depending on who's doing it.
Okay. Would Robert be one to do that or?
Yeah, he can do all that. He can do the outsource the foundation cert. He has a guy that does that, and then he does the tie downs.
Okay, I see. Okay, thank you.
Yeah, and he goes anywhere you need him to go, and he's cheaper than most, so and pretty quick. I mean, he's all driving around all the time, so sometimes you might not hear from him right away. But honestly, all the ones I worked with, none of them are great. So I'd say he's a good choice to kind of do it all in one house. You're not having to go to one place for tie downs and one place for the cert.
I see. Okay.
Another one a lot of people use is BACA. It's BBACA. They do a lot of foundation certs too. I see them a lot. So, and Robert works with them at times too. He does some work for them.
Okay.
Yeah, and then sometimes you got the wells. So if you got a well on the property, right, if it's a private well, you got to get a water test done.
Yeah.
If it's a shared well, really no limits for VA, conventional, or VA that I remember. I don't think there's any. It's really just FHA can only have 4 lots sharing that well.
Okay.
So 4 separate lots. But sorry to get off on the tangent. All right.
Thank you.
And if you ever have questions on I've done lots of them. Like I grew up out in Buckeye out west. And when I first got into mortgages, most of my loans were out on that side of town. So there's a lot of weird title stuff out that way. There's a lot of weird properties. There's a lot of manufactured. So I've seen you know, pretty much everything when it comes to goofy property stuff. So, you know, if you ever have questions or running into issues on something, I'd be free to give you any advice I can.
Okay, thank you.
Uh-huh. So, okay, yeah, this is a good one too. This is basically like loan programs by percent. This was for our last year. So 78% of the loans were conventional, right? So that's your biggest share of the market. But yeah, if you can't get a household, it's nice to get this other 9 to 8%, 4, you know, these other ones, anyone you can add that's going to help you sell the house. You know, you need a bigger pond, right? More fish. So the more fish you can get, the better. So let's see. So yeah, like if you're at a 350, basically sales price, you know, pretty much any loan will work. Of course, if it's USDA, it needs to be in an eligible area. 500. See, now you're getting a little high for FHA borrowers. So that, you know, they'd have to put 12% down. But conventional first time home buyer, they can do 3%. I get a lot of questions on the 3% down conventional. It's fairly simple, but it does get a little confusing. So if I have two borrowers and only one cannot have owned a home in the last 3 years, and you can do 3% down, that's like your standard conventional loan. But there's also Home Possible, Home Ready programs. So Home Possible is Freddie Mac, which there's two places that do buy up all the conventional loans that the banks sell to. One is Freddie Mac, one is Fannie Mae, and Freddie Mac's is Home Possible, Fannie Mae's is Home Ready. So those two programs, I think it's $70,200 income limit right now. So if you have a borrower that makes under $70,000 a year and they already own a home, or they've owned one in the last 3 years and they sold, they can still qualify for a 3% down conventional loan. And the nice part about that program is the rates are a little better and also the mortgage insurance. And we actually have another program. It's called Borrow Smart with Freddie Mac. Some of our investors offer, and they'll give these borrowers, depending on how much of their their income levels. Like if it's half of the 70,000, I think they give them up to like $2,500 credit they can use for down payment or closing costs. And if it's over that, they'll give them $1,250, somewhere along those lines. So it's an additional credit so if I have somebody that is in one of those programs, I always look to do that loan these days. They have to do an extra course. It's like $90, but it's well worth it for the extra $1,250, that they can use for down payment or closing costs. What we usually use it for is the closing, basically help with the rate or things like that. Okay, and that's pretty much, available to anybody who's in that income limit. So 650, yeah, FHA is pretty much non-existent. I mean, we do get some FHA borrowers that, let's say people that have a lot of money, make a lot of money, don't have the best credit, and they're doing a lot down. Sometimes they won't get approved for conventional still. So, some of them will go FHA, pretty small amount. Conventional still good at 3%, VA 0 down. USDA, as long as they're not putting or have the means to put down 20%, then they can still get a USDA loan. So even at this price, like most are going to cap us at that 647, 200, still not the 715. So basically they need to put a little bit of money down on that price point. And then, yeah, so 750 would still even work because it's 14% down, not quite the 20 for USDA. Conventional, 5% down, because at 3% down, it's too high, right? They'd have to put 5% down to be at this price point, basically. And then jumbos, there are programs that do less down on jumbos. We had a 3.5% down for a while. We've seen 5%, but honestly, like all that stuff with the rates increasing is pretty much gone. And any of them that do lower down payments, I mean, we're seeing like 8s, 9s. Like it's not really an option. So for jumbo borrowers, it's really just that 20% down. We can always split it too. Like we could do a first second combo where we do a first mortgage to maybe capture some of, maybe 80% of it, and then a second for the other 10, and that can keep it more affordable for someone doing jumbo. And then, yeah, VA, you can still do 0 down. Yeah, millions. So basically, you could still go conventional. There's people putting a good amount of money down, or we could do a second mortgage with it. So we can, let's say they only have 10% to put down. We could do a first mortgage up to that 715 and a second mortgage to get the rest. So they could do 10% down. And then, yeah, the jump, 20% down, VA 0. So let's do this. So this is another one that you're probably going to want to keep handy. It's kind of going over seller concessions. So the seller concessions are always based, like the percentage, like you would know, is based on the purchase price. So here's some limits. Conventional loans, if the down payment's less than 10%, the seller can only contribute 3%. So even if you want to give more, that's it. That's the 3%, which is good. We'll go over the buy downs some more in a little bit, but most buy downs, if you're doing a 2-1 buy down, is depending on the loan size, it's anywhere from like 1.8 to 2.2% is what you need to cover a buy down. But once you hit that 10% to 25% down, you can get 6% in seller concessions, and then from there you can do 25% or more, you can get 9. So that's a lot that you could ask for. When it comes to investment properties, conventional caps that at 2%, and you can't do buy downs on an investment home. It's only for primary and second. So on FHA loans, it's just a standard 6%. We have a few banks that offer a 3-2-1 buy down versus a 2-1 buy down. So the rate would start 3% lower the first year, 2% second year, 1% third year, and then fourth year it goes to the full rate. That gets a lot more pricey because it's based on that payment spread. So usually it's going to take closer to about 5%, 4%, somewhere in there to cover something like that. USDA loans 6% as well, and then VA is 4%. And what's kind of cool about VA, the seller concessions, if your borrower's having a hard time with debt to income, those concessions can actually be used to pay off a debt. Like if the veteran has a high balance credit card or high payment on a credit card, some of that money can be used to pay off a debt for the borrower to qualify. So that's kind of neat. No other program really does that. Side note on USDA too, if let's say you have a $300,000 USDA loan and it appraises for 305, we can lend up to 305 and use that 5,000 for closing costs. So it's not capped at the purchase price. It'll actually let you go off the appraised value for USDA loans, which is the only program that does that. So that can come in handy too. So honestly, right now, like really the best thing on the market is the buy down. That's going to sell homes. It's great for your seller. It lets them keep the price reductions do not help reach affordability as far as mortgage payments go as much as a buy down. Lowering the interest rate is a much better bang for the buck. So I would always offer a buy down first before you reduce your price. But this is a really good tool for, helping people want to buy and helping people sell their homes. If you ever want one of these on one of your listings, we'll be happy to put it together for you. Just something you can add into your listing or, push on social media or anything like that. So anything that, if you ever want one, just reach out. Casey's our marketing director here, and he can put together pretty much anything that you want to market with us. All right, so there's a link here as well for this buy down calculator, but it's fairly simple. It's it's the difference in the payment, and basically if the rate's 7.5, first year's at 5.5, that difference in payment is $5,519. So that's the first year cost for the buy down, and then you got your second year. So the rate's higher on that. It's the second year, so you don't need as much. So there you go. It's that 2.383 in this particular scenario with these particular rates to fund that buy down. What's cool about a buy down versus a permanent rate buy down is, like, when you do a permanent rate buy down, that's discount points. That's just getting a lower rate from day one for the life of the loan. If you throw let's say you throw $8,000 on a lower rate, some people choose that and that's fine. But the reality is the rates are going to get better. We'll see it next year, probably. Don't know when, but I'm thinking first, second quarter. A lot of these people, any loan we're doing today is really a fairly short-term loan for most people. So, if you do a regular loan and you just put all that money to just get them the lowest rate you can, you won't get down 2 points lower on a rate. It doesn't work like, oh, I'm going to put 2% discount points and my rate goes down 2%. It doesn't work that way. On the buy down, it basically does, but not in the regular markets. You might only see a change in rate of 0.5% or 0.75%. It could be less, just depends on the day. So when all those points are paid at closing, that gets them that rate, and then that money's gone. It's gone. They'll never see it again. They refinance in 6 months. They never really benefited from it, other than just hedging in case rates don't come down quick enough. On the buy down, though, the way it works is it's basically kind of in an escrow account. It's a subsidy account, and so the bank pulls these funds, this $8,000, they pull what they need to every month. So like first year, they're going to pull $459.99 every month out of that account to keep them at the, the 5.5 rate. And so that buy down account goes down each month according to that. So when they go to refinance or sell, let's say year in, they do something, they would still have like 12 months on the dot, they'd still have $2,820 in there. If whatever they owe on the house, that $2,820 will go on their reduce their principal balance, so their payoff will be less, so they don't lose the money. So that's why I'm a big fan of the buy down, because you don't necessarily lose that money that was paid in to do that. So I think that's a pretty cool thing. I think that was it on that, but yeah, any questions, guys? Like anything you're seeing or want to talk about? I don't know if the buy down is good. I think I might do like just show you a couple. I'll show you guys a house here. We'll use 699. We'll do a $500,000 listing. Can you see this screen?
No, I can only see the contact screen from the
Okay,
slide.
let me do this real quick. I'll share a different screen. Let me do this. I'll share screen. Okay. So I'm just going to give you guys a couple just to kind of see how it would play out. So we'll do that. So like on this house here, market rate, 500,000, 3% down. We got a $3,700 payment. If we do a 2-1 buy down for this person, that gets him down to $3,088, which is still, high, but that's what it is. So $3,088 a month. So, your seller throws in 3%, helps them get the buy down. They got a $3,088 payment. I mean, basically, let's do this. Let's just see what $400,000 does at 6.99. So look at that. To get that same payment, well, close to it. You could probably be at 410 basically. So yeah. So basically, to get that person the same payment, I'd have to lower my listing to 410. So affordability is what sells houses, right? Like what is it versus renting? What is it versus what it costs for me to live? So if you're trying to sell a house and you're trying to reach affordability, you're going to reach it a lot quicker on a buy down than you will by lowering your list price. Because you can see like lowering a listing 20,000. We'll just do it. We'll just do this. We'll say, we'll lower it 15,000, right? That's the buy down. So let's say you just lowered the price 15,000. Okay. So now we're at 3607. And before we were at what? 3711. So, I mean, we're talking about $100. That's good, but that 15,000 on the buy down drops at about, not quite 600, but pretty close to about 550 a month. So that's why, making sure you're offering these buy downs on your listings first before price reductions is huge. And I mean, even on on a 3-2-1, like if we can get enough money from the seller, you couldn't do it on that loan type, but just to give you an idea, I mean, that gets them down to $2,800 a month, so those are buy downs is what's going to keep us alive, keep people selling their houses, keep people buying houses until we get better rates. So make sure you understand it. And did you guys get the kind of how that buy down works? Like it's basically just the difference in payment. It's not like a discount point. It's just the difference. So if it's $500 a month savings for the first year, that's a $6,000 cost to your seller. The second year, it's a $3,000. That's $3,000. So $9,000 total to fund the buy down. Basically, it's just the difference in payment for those 2 years versus the real payment when it's at the full rate. And if you ever need help on that, I'd be happy to do so.
Andy, I have a question.
Yeah.
So what's the difference between your buy downs compared to other lenders?
Most buy downs are pretty much going to work the same. The difference would be like if you're talking to, a mortgage bank versus a broker, and some call themselves broker, but like your academies, your homeowners, your Nova, Fairway, These are retail banks. They have more overhead. They have underwriters that are in-house. They have tons of levels of management. They have branch managers. They have all these people they got to pay. And the rates are inflated compared to what we can do, how we're modeled as brokers. So the difference is, like, let's say I'm at 6.99 today. If I quoted someone, let's say I went to, I asked a buddy at Nova or something, he's probably sitting on the same loan. He's probably sitting at 7.75 or 7.5 or even 8. So even though they're doing a buy down, if they're at 8 and they're going down 2, they're at 6. I'm at 5, you see? So the difference is affordability. The lower the rate, the more people you can get to buy. So, I mean, definitely keep these types of lenders in your pockets. They have things that, we may not have, or they're like the Home Plus or whatever's available now in those types of bond programs with the state of Arizona. But for anything else, like, we're going to be better. Our FHA rates, government rates are always a lot better. So it's really all about affordability. It always has been. It wasn't as apparent when rates are as low as they were, but now it's really apparent. So when you're working with retail lenders, it's usually going to be a higher rate than what we're going to be at. It could be 0.5% to 1% higher, and they're going to have the processing and underwriting fees and these things that we don't have. So whenever we are looking to buy down rates and things, we have that extra money to work with that can help with rate versus just paying extra fees that don't have anything to do with your rate. So that's really the biggest difference. Also, some of them don't do like a 3-2-1 buy down, which, we have some that do. It's not a lot of people do those. Some don't do conventional buy downs or FHA buy downs or VA buy downs. So we have pretty much any loan type other than jumbos. You can't do buy downs, and investment homes, you can't do buy downs, but any other loan we can do them on. So we have options on those. What else are we going to say? Oh, on DPAs as well, if you're doing down payment assistance, you can't do any buy downs on those either. So that kind of limits that as well. And we do have some DPAs that lend on manufactured homes that go down to lower FICO scores than the ones that the banks have. Like, most of them need a 640, 660. We can do a 600 score or even 580 with some guys. They're always changing, but we do have options for those people that could work. It's really hard to get a DPA file to get an automated approval if it's under a 600, but sometimes they do if they have a lot of reserves and things like that.
Andy, I have a quick question.
Yeah.
How do you know it's a retail lender as opposed to a regular mortgage company?
It's kind of hard because they don't usually spell it out. I mean, a lot of brokers push that they're brokers, but the retail guys don't really say much. So again, it's usually anybody that says they have an in-house underwriter, which sounds great. I've worked at places that have them. I've never preferred it. It's a lot of politics. They're kind of limited to a few people and their perspectives on how to guidelines and things. On our side, we work with lots of the same underwriters, but lots of banks too. So we might have a scenario where I check with 10 different banks and 7 say no, and I got 3 that say yes. And so for them, they go to one person and it's a yes or no and they're done. They can't shop it. They can't look for other options. But like, again, it's like your Academy, Fairway, Nova. There's a ton of them. I mean, basically any of these big name ones like that, they're going to be AmeriFirst. Who else you got? There's a ton. I mean, there's a lot of them, right? But those are the ones that's like a mortgage bank, not like a Chase or those guys. That's different. But these types of lenders are ones that aren't going to be able to provide as many options because, again, they're dealing with one set of guidelines, one rate sheet. They can't shop. They can't look for other options for customers in the same way that we can as brokers. So if you ever have one of your lenders say no, throw it my way. We'll see if we can say yes. And that's why I'm a broker, because one, I can provide lower rates, I can provide less fees, I can provide more options. So it's a win for me because I can say yes to more people. It's a win for those people because I can save them money and say yes too. And it's a win for you because you can close more loans, right? You can close more transactions. So
right. And the reason I ask is sometimes buyers come to us already with what would be maybe a retail lender because they're a friend or something like that. So I just want to be able to explain it correctly if I want them to get another.
Yeah, I would say, in those cases, It's kind of one of those, what's PC, like if they express pain on what they're paying in points or the rate, or they're not getting pre-qualified high enough, or the funds to close are too high, that's a great time to jump in and say, hey, it might be good to talk to a mortgage broker. Here's Andy's info. Basically their rates will be better. They're going to have less fees. That will either make them qualify for more house or get them a more affordable payment. Things of that nature. Maybe they can't do it because the FICO score is too low. Like some of these guys, they can't go under 620 or 640 on an FHA or VA loan. I mean, we have options down to basically 550, sometimes lower for these customers. So it's just one of those things, especially if they get a no. If it's just they say no to them or they can't do something, that's a great time to introduce them to somebody else, provide that value to your customer. I also was talking to I think it was Debbie Smith the other day, Hughes, and if I was a buyer's agent right now and I wanted to differentiate myself or get more buyers, agents can contribute to the buy down. It has to come from one party, but you can do a 1-year buy down as well. And so you could say, hey, I'll help you have I'll give you a credit to keep your rate 1% lower for the first year. Like that's a great way to pick up more buyers, like just offering that. Obviously you're going to take a haircut, but I mean, it's another customer to add to your database. It's somebody to help sell their home later. It provides value, like just helping people with certain things like that, just to get new customers to grow your database versus, worrying about every dollar is something to really consider in the market we're in right now. So, things like that can go a long way for people and help you capture more customers.
Yeah, that's a great idea. Thank you.
Yeah, for sure. Is there any other questions? Another one too, VA. There is really no limit on a VA loan now, but a lot of banks do have caps on them. Some are going to be $1 million, $2 million, $3 million. We have ones that go up to $4 million for a VA loan, 0 down. And with VA loans, there is no limit unless they have another VA loan, right? And they're not going to pay it off before closing. So if they have 2 VA loans, they have the one and they're getting a new one, there is an entitlement worksheet that we would put together to see what their max price is at 0 down or how much down they'd have to put if they want to go over that. So if you ever have a borrower that has another VA loan, that's something to have them check with their lender on, or I can do it too, just to kind of give you some numbers on it for them. But there is limits in that case. When they don't have another VA loan or it'll be paid off by closing, then there really is no limit and 0 down, right? So that's something to keep in mind as well. Jessica, is there anything else any other questions that we didn't catch in the chat?
No, but one thing I was going to say is I'm big on always having options. I think, was it Danny just asked about, the difference between a broker and a lender, but I always think it's important. I don't know how you can explain this to them to have, if they do have a lender or bank they're using, to price it out without them making them feel like they're going to damage their credit because they're using, having somebody else pull it. So maybe you can just express like when you're shopping the rate or shopping around.
Yeah, I mean, I have agents that will kind of do a price check with me, like, hey, what are you at on this credit score and in this scenario? And I can give numbers because, I mean, it never hurts. I mean, I know it's good to kind of keep it separate, but you're also a fiduciary to them and you want to make sure that they're not, getting taken advantage of. And it's just another thing to kind of add value. Like, yeah, send me it. I can make sure that this is in line with market. And I mean, if I had a loan estimate, and I knew the credit score, I could simply just run a quick scenario to see what it looked like without checking their credit. Another big thing to explain to your clients too is, within that first 14 days of that credit check, any other mortgage credit check isn't going to ding them. It'll show up as an inquiry, but it won't ding their scores. And mortgage checks aren't going to beat you up as much as like auto loan shopping and things like that. They want you to shop for a mortgage. So it's not going to be as bad as like when you get an auto loan and there's 20 inquiries. It doesn't like that, with mortgages. So people should be less afraid of getting their credit checked versus paying way more than they should for a loan.
Yeah.
So
yeah, I think that's the misunderstanding that a lot of them will have, is thinking it's going to ding their credit. So
yeah, it's like, oh, I'm going to lose 5,000 and pay 200 more a month because I didn't have someone else check my credit, and especially within that first 14 days when it really doesn't make a difference anyway.
Mm-hmm.
And we also do soft checks. So a soft check is where we do an inquiry, and no inquiry shows up. We can't use it to run it through the underwriting engines, but we can see what their scores are. We can see what their debts are. And we can, if everything looks well within limits, we can issue a pre-qual on that. I always prefer to do a hard check before we issue a pre-qual, but it does let us kind of test the waters for the customer without them getting a hard inquiry on their credit. So we do that a lot of times too.
Nice. Okay.
Well, good stuff. Well, I appreciate
Yeah,
everyone
this is
joining,
really
and
good
you
stuff.
will get a recorded link. So if you want to share it with anybody or go back and reference it, or if any questions come up, just reach out. I'm not, I'm accessible, and I'm, any questions on anything, I'm free to answer those, no strings attached. So be happy to help. Okay.
Thank you,
Thank you.
Andy.
All right. Thank you all for joining. Have a good rest of your day.
Thank you, you too.
Bye.
Thanks,
Thank
you
you.
too.
Thank you all.